This is the Everything Financial Radio Program. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. If you are a regular listener, welcome back. If you're a new listener, this is the place where we educate you about the economy and your money, and we have a terrific show lined up for you today. This past week, I had a conversation with Dr. Gary Shilling. Many of you know Dr. Shilling as a 30-year Forbes columnist, also the author of the must-read book, The Age of Deleveraging. Dr. Shilling is known for his economic forecasting prowess, and certainly excited to share the conversation that I had with Dr. Shilling this past week with you. Also, we're going to go back in time on the fourth segment of today's program, and I'm going to share with you what we can learn from a housing bubble that existed from 1830 to 1836. I'm going to share this with you because this past week I had a number of folks tell me that the housing market has recovered. They've listed their homes for sale and within just a few days gotten multiple offers to sell their home. Does this mean that the real estate market has recovered and the economy is on the mend? I'm going to share with you what we can learn from different points in history when we've had housing bubbles. So you'll want to stay tuned for that as well. China also this past week reported that economic growth is slowing to the slowest pace in the last 13 years. The Chinese economy is experiencing a decline in exports. In fact, China has number one and number two markets, I should say, are the United States and the European Union. Exports to both the U.S. and Europe from China have fallen from a year earlier. That trend is continuing for 3 months, and we're beginning to see signs of deflation in China. So we'll talk about that and what it might mean for you and your money as well. Want to remind you that our class New Retirement Rules. The class carries a $49 charge to cover the cost of books and handouts. And during the class, we study history, and we study what's happened at different points in history when central banks have printed money, when debt levels reach the levels that they are today. What has happened? And you may find that where we go from here is somewhat predictable. So the class is something that if you want to educate yourself about the economy, about how it may affect your nest egg, that I would encourage you to check out. You can get more information about the class at the website, newretirementrules.com. The website is newretirementrules.com. You can register for the July class there or get more information if you'd like. The June class did reach its capacity. We were not able to add anyone else to the June class, so we are adding a class for July. There is capacity. Again, just go to the website, newretirementrules.com, to register or get more information. On the website, there's also a phone number that you can call if you'd prefer to get more information or to register by phone. I am pleased to have back on the program with me today Dr. Gary Shilling. Dr. Shilling is president of Gary Shilling and Company. In addition to his forecasting record, his portfolio management, and his column for Forbes, which he has written since 1983, he's also known for his well-received books concerning economic themes and investment strategies, and for his numerous articles on the business outlook and techniques of economic analysis and forecasting. His latest book, The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation, is a must-read. Dr. Shilling, welcome back to the program.
Delighted to be back with you.
You know, Dr. Shilling, in your latest issue of your newsletter, Insights, you discussed the fact that the Federal Reserve has been attempting to achieve a target inflation rate of 2%, and they've fallen far short in spite of unprecedented levels of QE. The question is why?
Because there's so much deleveraging going on in the private sectors around the world that it is simply swamping not only the tremendous fiscal stimuli that we had earlier in this country, that's now been cut back a bit, but the ongoing monetary stimuli. All the quantitative easing is simply being offset by this deleveraging in the private sector. And that's been a huge shock to a lot of people, particularly those who thought inflation was going to take off and instantly, and as a result they rushed into gold and obviously have been sorely disappointed.
Now, in your newsletter, Dr. Shilling, you discussed the relationship between the Fed's actions and stock prices, and you mentioned that there's really been a new dynamic emerging since 2008. Can you explain?
Yeah, I call it the grand disconnect because we have the economies of the world that are limping along at best. Now, the U.S. is the best of the bunch, the best horse in the glue factory, and it goes down from there to declining growth rates in China, absolute recession that's deepening in Europe. The world's economies are really in pretty weak shape, but yet investors, at least up until recently, and this may be changing, they couldn't have cared less because their only concern was what central banks were doing in terms of shoveling money out the door. The idea is don't fight the Fed. If the Fed is being so aggressive on quantitative easing, buying securities, putting money into circulation as a result, that's the only thing that people worried about. And that's a very unhealthy situation because you've had this tremendous emphasis on equities that's not been supported by what's happening to the economies on the ground.
Well, Gary, I want to go back and revisit Europe with you in a moment, but while we're on the topic of U.S. stocks, what is your forecast for stocks both in the U.S. and worldwide moving ahead?
I think they're very vulnerable for several reasons. One is that we are in a secular bear market. Now, I know that stocks have hit all-time highs, but if you correct for inflation, they have been down in a sawtooth pattern since 2000. That's when the economy really topped out and slower growth started. Also, the reason that profits have grown in this country has really been because of cost cutting. It hasn't been because of ability to raise prices or big volume increases. It's cost cutting, and it looks like that's becoming more and more difficult. Labor costs, of course, have been the primary target. Productivity enhancement with equipment, high tech, low tech, no tech, but we're not getting the productivity growth we saw earlier. And also, you look at companies now that have international exposure via exports or foreign operations, the strong dollar translates their earnings into fewer dollars. It's called the translation losses. So you got a number of factors here that I think make stocks vulnerable. And then also, just recently, we're seeing this concern that the Fed may not continue to buy $85 billion in securities every month. I think they will. I don't think the Fed thinks the economy is strong enough that they can cut back on that largesse or even detract it, even though they've got to worry about the excess reserves they created long run. But in any event, people are now in a different state of mind. If you go back from late last year through the first quarter, this idea of this grand disconnect, as I call it, and also the zeal for yield. They're buying junk bonds, emerging market debt, leveraged loans, anything with a high yield, irrespective of risk. That was a period of euphoria in effect, and now the scales have dropped from the eyes. I think people are looking at the world very differently.
Well, if you're just joining us, we are chatting with Dr. A. Gary Shilling, president of A. Gary Shilling and Company. Dr. Shilling, one of the goals of the Fed's easing is to reduce the unemployment rate. And in your most recent newsletter, you discussed the fact that the participation rate in the labor force has declined by about 4% since 2002. Two questions. Has the Fed's easing had any effect on the unemployment rate? And then secondly, could you explain to the listeners how labor force participation rate affects the official reported unemployment rate? A lot of folks just don't understand that.
Yeah. Well, the Fed probably has some effect on unemployment. Of course, you never know what would have happened without the Fed. There are no ifs in history. History isn't a controlled experiment. It isn't a situation where you change one baffle in the maze, run the rats through again, and see which way they turn. But the point is that the Fed cannot directly impact jobs, even though full employment along with price stability is their dual mandate. But when they buy securities, they hope that the sellers, that the price will go up, and it has on stocks on balance in the last year or so, and that then people will feel wealthier, they'll go out and spend, it'll eventually create jobs. But it's a number of steps there. There are 5 steps I just outlined in that sentence. And it hasn't really, let's put it this way, it hasn't returned the economy to the rapid growth earlier, and the unemployment issue is still a problem at 7.6%. The Fed probably would like to see it more like 5.5%, and they say they're going to continue to ease until it gets to at least 6.5%. Now, in terms of labor force participation, that has dropped, but a lot of the decline, in other words, if you had the same number of people working now per their age groups as you did in 2000, you would have 9.8 million more people in the labor force, either employed or looking for jobs. That's defined the labor force. It's the sum of the two. You really though have only about 2 million of those people because the participation rates have declined. Well, they've declined principally because of demographics. As people age, move toward retirement, they're less inclined to be either working or looking for jobs, and that has changed the situation remarkably. Now, in terms of the unemployment rate, of course, if people drop out of the labor force, in other words, they're not looking for jobs or employed, it would tend to push down the unemployment rate because unless you had a comparable cutback in jobs, then you would have fewer people looking for work. So it does have a positive effect probably on the unemployment rate, but there are a lot of other things going on. You know, the weakness of the economy, the fact that people don't have as much income, so they're not spending as freely. There are a lot of other factors.
Well, we will continue our conversation with Dr. Shilling in the next segment here on Everything Financial Radio. Stay with us.